Good day, everyone. We are back with a Q&A session. I'll start with asking a few questions to Erik that has come in on the E&P side, and then Erik will move on to asking me a couple of questions on the rig side. The first question we've had from the listeners is, what is the level of oil hedging for the companies you've presented in 2022?
It is very limited, basically, for almost all of them. So to kind of talk about it in general, what you typically see among the E&P industry is that most companies prefer to stay as much spot as possible, and the same basically on the investor side as well, because if you want to buy the equities, you want exposure to the commodity markets as well often. So, and it's of course you have to pay to hedge basically in normal circumstances. So quite limited. There is a couple of cases, of course, if you just done an acquisition or part of an acquisition financing, you say in Pareto, for instance, they have quite a lot of hedges because they had quite a lot of leverage in that acquisition deal. Africa Oil used to have the same, has a bit less hedging now, but still kind of quite significantly hedged. I think an important point there with the company's hedging as well is of course that when they now roll it over, exactly at this point in time, of course, you didn't want to enter into a forward sales contract 6 months ago, but you will at this point in time be able to roll it over at better terms than before as well. But in general, very limited. The big oil companies stay completely spot, most of them. That's both due to size, basically how much they are to sell, and because the hedge is basically for companies like Aker BP, for instance, and Equinor and others in this space. I think the best hedge is low production cost, basically. That's the best protection you can have. Some of them has taken out options at lower levels. That's something we actually quite like. That's to take out kind of the ultimate downside risk. A company like War that recently IPO'd, for instance, in their presentation showed that they have hedged quite a lot of volumes this year at around $50 Brent with options, so they have complete upside on the volumes, but if things gets very, very sour for some reason, call it a new COVID shock like what we experienced in 2020, then of course that's beneficial to have to basically protect the capital program and balance sheet, but in general quite limited. And I would say also many of the companies I showed on the slide here now, we're talking about the great times today, but those balance sheets improved quite a lot last year as well, so many of them are close to net cash, so then the need for hedging is also less. Yeah.
That's a good E&P analyst to have all of that on top of his head. Could you please provide an update about possible effects regarding Iran's missile attack to the Kurdistan region, Erbil?
Yes, this happened yesterday. Obviously not good news. Highlights geopolitical risk in the region, no doubt negative, and it just escalates what we see around the world. Without not getting too much into politics here, I think Iran sources have stated that they believe they target their Israel sites or kind of strategic locations, or what they call it. There's obviously not the best friends, especially in the conflict in Syria. It's of course negative to see that get a spillover impact into Kurdistan, into Iraq. You already seen the US reaction in terms of condemning the attacks, and some of the missiles here landed quite close to the consulate they have in Erbil as well. So very serious situation, and not good at all. Luckily no one it's only material damage at this stage, so no life has been lost, luckily, but still very negative, of course. I think in terms of direct exposure, the Kurdistan companies should not get, call it, any implications from this, but of course it highlights kind of where in the world you're located and the risk of that. So it highlights a bit why these companies are priced towards the low end of the sector, of course. But still we think that looking through that a bit and just seeing how much cash the current business generates, of course what's great in Kurdistan, the great thing is the Middle East oil reserves, right? It's the $2-3 per barrel cost and exposure to millions of barrels that also was cheap to develop. But it comes also with another side of geopolitical risk. So highlights that difficult to forecast the future, but hopefully it will not escalate.
Good.
Yes.
Next question. There's talk of windfall taxes rearing its head again for E&Ps. Any threat of this in Norway as well?
No, we don't think so. Norway has had a very stable regime on taxes, and they basically what changes that we have seen in recent years has been something that's been welcomed by the industry. It's also been a bit of what you've seen in Norway, for people not looking at this in detail, basically last couple of years has been almost a cost of capital arbitrage, where you're seeing that the cost of capital for the E&P sector is coming up quite a lot. With the COVID shock, for instance, you also saw then what you did basically was to protect the demand of the oil service industry to a large degree, because all the E&Ps, of course, just shutting down the capex programs. So what the sector did was, or the state did, which we think was quite clever, was to actually increase the absolute amount of taxes to be paid, basically a bit over time. That's the new proposal coming now, but at the same time, providing the cash back much faster. So previously you were to depreciate your tax balances over 6 years. Now that will be a lot faster. Majority is in year 1, you get it back. So that means, of course, that you have to put less capital in the ground. You need less capital to grow, and that's quite beneficial given the increased cost of capital for the industry. It also means that while you are developing, you are less oil price sensitive than previously, because you don't have to have such a buffer to take that hit of both having to pay the capex of something that's coming online in 3-4 years, a big offshore development, and at the same time kind of seeing your earnings being reduced, so to the same degree. So short answer is we don't expect that. We also see a lot of the players. If you take the big companies now, you take Equinor, of course, what is happening here right now, it's a huge windfall for the renewables business. Of course, they will have almost unlimited capital if they are able to bring good projects to the table. You see Aker System in Norway, one of the very big industrial companies we have here, they're moving basically capital from E&P, from Aker BP, that's a cash flow machine, into these sectors as well. So I think that focus is kind of where the capital is going, and we don't expect the tax rates to be increased.
Should we do some rig questions as well?
Yes, carbon capture. I must say, I thought 2 years ago I would never think that I would ask the rig analyst about carbon capture, but there is some talk now, and people are looking a bit ahead, and you've also seen some contracts already, haven't you, on the carbon capture side? What's happening there, and is there a market opportunity to actually drill carbon capture wells, basically, where you take the carbon back down again?
It's a fantastic question. I was so much hoping for this question, actually, that I have a few slides prepared. So you could almost think that it's a rig question. It's not, but I'll bring up a few slides.
Could have been.
It could have been,
Yeah.
and it's good to see that there's some interest picking up on that end of the rig scale as well. So hopefully the slides are up on your end now. I'll just quickly run you through our estimates on this. For those of you more interested, we have a full report on it from mid-December. So this was the focus in mid-December, and first of all, CCS, offshore CCS requires drilling, right? So CCS and the storage part of it, where you do not utilize the carbon for other purposes, requires you to drill a hole in the ground and then shove that carbon down in that hole. So what you can see on this slide is the International Energy Agency's estimate for required CCS capacity in order to meet net zero. So it's to an increasing degree viewed as a pivotal part of the way towards net zero and part of the energy transition. So the green bar on the left-hand side of this slide is 7.2 gigatons of CO2 required storage capacity per year. If we break up the bars, the green bars on the left-hand side of the slide into incremental required capacity on a 5-year basis on the right-hand side of the slide, you can see the capacity that needs to be developed within a 5-year time period. So in order to bring that towards rig demand, you need to have an estimate related to the well capacity, or the capacity to store CO2 per well. So what you can see on the left-hand side of this chart, and sorry if I'm going a bit quickly, but it's a long story short. You see that on an estimated 0.7 million tons of CO2 per 700,000 tons of CO2 per well, you'd need about 600 wells drilled on average between 2030 and 2035. So a meaningful amount of wells. The confidence interval is very big because there's a lot of uncertainty tied to the capacity of a well within this industry. But you can then take the number of wells, convert it into rig years. Here we use 75 days per well, which is the best estimate we have based on what we're seeing in Greensand's and Northern Lights. And there you can see that based on these estimates and these calculations that are, and there's lots of uncertainty tied to them, you could see upwards of 125 rigs drilling CCS wells between 2030 and 2035. So not a lot of people are talking about this yet, but it's a relatively meaningful number, 30% of current demand. So the big problem with this is that we do not know if it's going to be onshore, offshore, shallow water, deep water, Brazil, Norway. So a lot of uncertainty tied to where these wells will be drilled, and time will show sort of what regions will focus on this, even though it's starting to become apparent that Norway and the US are focusing on it. So I guess that's the long story short. Yes, rig companies could benefit from incremental demand from a market such as CCS when time comes.
Thank you. Another one on the rig here. Basically, as we now see rig rates coming up and the rigs becoming more expensive again, while second-hand value seems to be lagging, or at least pricing of listed companies. Do you think you could see international oil companies acquiring drill ships for their longest tenders?
It's a good question, and it's not a question I've spend a lot of time thinking about, so I'm going to go with the intuitive answer, which is no. So historically speaking, yes, we've seen IOCs and majors acquiring drill ships to cover their demand when there's a lot of uncertainty tied to them, the availability of supply in the time going forward. However, that was a long-lasting super cycle. We're not pricing long-lasting super cycle in at the moment, and I think it would be surprising to see IOCs and majors starting to acquire drill ships. However, we are seeing national oil companies buying assets to secure their capacity in the time going forward, and Turkey is a good example of that. And they've acquired multiple drill ships over the course of the past few years. They're probably looking for more, and such customers could be part of the demand side to bring second-hand values higher.
And then one more on rigs. Which segment do you think is the most attractive in the short to medium term?
Very good question, and it requires a nuanced answer. I think the harsh environment market, for several reasons, looks very good because there's a restricted supply side. Utilization is fairly high at the moment. We have the underlying demand that we know is coming from the temporary tax relief in Norway and all projects that will be sanctioned before 2022. And on top of that, the harsh environment geographies have become very strategically important shelves in the midst of the geopolitical turmoil at current. So we like that market, but at the same time, the movements in the ultra deep water market that are coming from significantly lower levels and where the pricing of the equities is 60% of the harsh environment exposure out there, to be maybe the most exciting one at current. So I'd say the ultra deep water floater market has been through the biggest structural change on the supply side with respect to the number of assets and the holders of those assets, and where we could see the biggest surprises on the upside for day rates.
Thanks. And what is the cost of reactivating an ultra deep water ship?
I wish I had the exact number, but I think important to keep in mind when talking about reactivations in the ultra deep water market is that it's on a continuum, right? So cold stacked asset is not a cold stacked asset. You can have a cold stacked asset that costs you 50 million to reactivate, and you can have cold stacked assets that cost you 150, and the assets that are out there will be somewhere on that cost scale. So the ones that are being reactivated now are at about 50, roughly. the ones further down the pecking order move towards 150. So for all practical purposes and in our models, we use 75 as our best case estimate for the average of ultra deepwater assets out there.
But one follow-up from me then. How do you think about that if you get to those, call it 150, it starts to be quite a significant amount of capital putting into, call it still an old unit, and how much do you think rates will have to move before people even think about that? And coming from the oil company perspective as well, having seen now several years with better rig performances and all of that, and being able to talk about that at the capital markets days, is there kind of a cut-off where assets, even if they are cold stacked today, you actually don't believe that they will ever work again?
Well, in the end, it's all a matter of the contract economics, right? So if we start seeing day rates of 400,000 a day for long-term contracts, absolutely, and you can secure that you're being paid back for your investment, then sure. Those are still very good assets. They require a bit of care and love to get back into the marketed supply, but that high reactivation cost is definitely a contributor to a push on day rates upwards. And I'll just add to a second dimension to the cost itself is also the lead time to reactivate assets now. Yeah. We've seen a disruption to global supply chains within many industries, right? So if you order a car these days, it'll take you a year and a half before you get it. So imagine what it takes to reactivate an asset that will cost you $1 billion to build, right? It's a big logistical chain that has been disrupted on a global basis, and the time to reactivate and the availability of those far out the curve reactivation cases is something that needs to be taken into account as well.
Thank you. I think we will end it there to not go along for all that too long. So with that, thank you for everyone for following, and we will be back with more shortly.